A health savings account is one of the most underrated investment accounts available to us, in my opinion. And here's why. Despite the name savings account, you can actually make investments inside of your HSA. You can invest your HSA in the market through mutual funds, just like your 401k. A lot of people don't realize that. And then not only that, but it's also the only triple tax advantaged account out there, meaning that there's three main tax advantages here. The first is on the entry, meaning that the amount that you contribute to the HSA will be deducted from your taxable income for that year of your contribution. And if it's an employer-sponsored HSA, meaning that you make contributions through your payroll deductions, well, you also get to reduce your Social Security and Medicare tax as well. And then while the dollars are invested, the growth inside of the account is also tax-free, meaning you don't pay taxes on any dividends or capital gains while it's invested. And then the third tax advantage is on the exit, meaning that the amount that you take out of the HSA, as long as you have a qualified medical expense, will be completely tax-free on the exit. So that's why it's triple tax advantaged. Another little known fact is that the qualified medical expense does not have to occur in the same year as the HSA withdrawal, as long as that qualified expense happened after the HSA was open. So let's just use an example here. Let's say a family has incurred $20,000 of medical expenses that they didn't use their HSA for and they paid out of pocket for over the course of 5 years. That's $20,000 that they can distribute from their HSA in the future. So let's just say in the future, they're going to be in a much higher tax bracket and they want to make a large purchase and they want to liquidate an account without incurring extra taxes on top of that for the liquidation. As long as they have evidence of the $20,000 that was spent on qualified medical expenses, they can withdraw from the HSA for $20,000 completely tax-free. That opens up a lot of planning opportunities over time. You have to be careful because if you do not have a qualified medical expense as evidence for the HSA distribution, not only will the amount of the distribution be taxed as income, but there'll be an extra 20% on top of it. So we definitely don't want to take that hit. However, once you turn 65, you can distribute from the HSA and that 20% tax penalty will go away. So it's almost as if it's a traditional 401k or traditional IRA at that point because you made the deductible contribution when you added to the account and now it's just taxed as income upon the liquidation. To qualify for an HSA, your family needs to be covered by a high deductible health plan. As long as your family's covered by a high deductible health plan, you can contribute up to $7,700 in 2023 for your whole family. That $7,700 does include any employer contributions as well. So let's just say if your employer contributed $500 for the year, you'd only be able to contribute $7,200 to the HSA. So if your family qualifies for an HSA, I would definitely consider contributing to it and give yourself a little bit more financial flexibility for the future.